All right, next we're going to look at short-run supply under perfect competition. So to find out what our competitive individual producer, in this case of portable power banks, is making in terms of profit in the short run, we have to determine the excess of price above average total cost. Right? So in other words, if we want to figure out what the firm's profits are, we need to determine how much price, the price that it's taking from the market, exceeds its average total cost. All right, so previously we saw that if we have production and sales of 7 portable power banks, total revenue was $35, total cost was $30, and therefore profit was $5. And these are all in per hour terms. Now we take info from column 6 and add it to panel C to get figure 23-3. Here we go. All right, so this is just illustrating some of the information that we saw in that table from earlier. Of course, we have the demand curve here, which is just the price of $5. We had an average total cost that has this U shape here. And then we have our marginal cost curve here, which also kind of has a U shape. And of course, the firm is maximizing profits by finding where its marginal revenue curve, which is the demand curve in this case, where that equals marginal cost, right? So where does marginal cost equal marginal revenue? It's right there where they intersect. That tells the firm how much to produce in order to maximize profits. So it's going to produce 7 units. Okay? Now that we know that that's where it's going to produce, the quantity that it's going to produce to maximize profits, now we can figure out what its profits are graphically. Okay, so if we look here, the difference between price and average total cost, that little difference right there, that difference is profit per unit. All right, it's selling each unit at $5, and it's costing on average about $4.50. Okay, so in other words, the firm is making 50 cents of profit per unit. And then if we multiply that by the number of units, we basically get the profit, which is this rectangular area that's shaded light blue. Okay, so graphically, that's what profits look like. So again, the height is profit per unit, and the length is the number of units produced. So if we multiply those two together, we get the area of that rectangle, which is total economic profits. Now, short-run average profits are determined by comparing average total cost with price, which is equal to marginal revenue. It's also equal to average revenue. It's also equal to the demand curve, right? Market price as well. All of these things are equal under perfect competition. Now, in the short run, the firm isn't necessarily always making profits. It can sometimes also make losses, which makes sense, right? Firms don't always make profits. So what do losses look like? This is what losses would look like, right? So here we go. We've got demand 1. Now, suppose there's some event that causes the price in the competitive market to drop from $5 to $3. Okay, so when the price was at $5, the firm was making a profit, right? That difference there is the average profit or profit per unit when the price was 5, but something happens and causes the price to drop, and in that case, the firm is sort of going to recalibrate. It wants to still maximize profit, right? So now the marginal revenue curve has come down, and so it's going to reduce its production in order to maximize profit, which, recall, is the same as minimizing losses. So now that price has dropped, it's going to recalibrate. It's going to find where marginal cost equals the new marginal revenue, which is here, and produce that quantity in order to minimize its loss in this case. Okay, so this is the price, and this is the quantity that maximizes profit or minimizes loss. And at that quantity, here is the average cost per unit, right? coming from our average total cost curve. So now we're in a scenario where the price the firm is getting is less than the average cost per unit. And so since that's the case, this height here is now a loss per unit. And now we're going to do the same thing. If we take loss per unit, the height here, and multiply it by the quantity produced, we get total loss. Okay, so this is what a loss looks like. Now something else I'll point out, it's very easy to visually determine whether the firm is making a profit or a loss. You'll notice that when it was making a profit, the demand curve crossed and was above the average total cost curve. So anytime that the demand curve is crossing and above a portion of the average total cost curve, the firm is going to make a profit. In this case, when it was making a loss, you can see that the demand curve is entirely below the average total cost curve. So that's a very simple way to tell visually whether the firm is making a profit or a loss, whether it crosses and is above average total cost curve, which is a profit, or if it's below the average total cost curve, in which case it's going to make a loss. All right, so what we see, or what we saw in that last figure, is that marginal revenue is intersected by the marginal cost curve at an output of 5 portable power banks, and the firm is not making profits because average total costs at that level of output are greater than the price, right? So the amount of money they're making per unit is less than the cost per unit. And those losses were shown in that red shaded area. All right, so thinking about all of this, what do you think? Would you continue to produce if you were incurring a loss? Well, the answer might depend on whether you're in the short run or in the long run. So recall that in the short run, you have, as a firm, some fixed costs, some costs that you cannot change. Whereas in the long run, all of your costs are variable, right? So remember that. And as it turns out, your answer to this question is going to be different whether you're in the short run or in the long run. So what is the answer then? How does it depend on these things? So as long as total revenues from continuing to produce are greater than variable costs, then the firm continues to stay open and produce even though it's losing money. Okay, so that might be somewhat confusing to you at first. We'll talk more about why that's the case. Now, if the firm's not able to make enough money to cover its variable costs, then it wants to shut down, at least temporarily, perhaps. Okay, so that's what we're going to look at here next. So what we're seeing is that as long as the firm can cover its average variable cost or its total variable cost, as long as price is above average variable cost, in other words, the firm would continue to make units, continue to produce, because even though it might be making a loss, its loss is smaller than if it shut down. Okay, if it shut down, it would actually make a larger loss. Its loss would be larger. Okay, so as long as the firm can cover its variable cost of production, it wants to stay open even if it's making a loss because its loss is smaller than it would be if it shut down. And we can there's a threshold basically that determines whether the firm should shut down or continue operating at a loss, and it's called the short run break-even price. I'm sorry, that's actually what I just described as the short run shutdown price. The short run break-even price is the threshold where the firm makes zero profit. And so above that, they make a profit. Below that, they make a loss. And then right at the break-even price, they make zero profit. Okay, so we have kind of two thresholds that are going to tell us what the firm wants to do in terms of producing or shutting down. And then if it is producing, the break-even price is telling us whether it's making a loss or whether it's making a profit. All right, so this is what it looks like in our graph. So here again we have two different demand curves, one at a higher price, one at a lower price. Now, right here, at the minimum of average total cost is the break-even point. Okay, so the minimum of average total cost is giving us that threshold where the firm just breaks even, right? It's not losing money, but it's not making a profit either. So it's just breaking even. Okay, so it looks like that's at a price of $4.50. If we look at the minimum of average variable cost, that's telling us the shutdown point, right? That's telling us if the price that the firm is taking is below this, then it should shut down because it can't even cover its variable costs. But if the price that it's receiving per unit is above that, then it's at least able to cover its variable costs. And so anything it makes above and beyond its variable costs, it can use to pay a portion of its fixed costs, which it has to pay whether it operates or not. Okay, so that's why this is the shutdown point. Now, what if the short-run shutdown prices differ across firms that constitute a perfectly competitive industry, right? So what if not all of the firms in the market have these same variable cost curves, right? Some of them maybe have higher costs, maybe some of them have lower costs. What if that's the case? Well, the utilization of varying mixes of inputs and technologies can cause differences in these shutdown prices, right? And differences in these cost curves, which translates into differences in shutdown prices. And so basically what happens when the market clearing price in a perfectly competitive industry declines sufficiently to induce some firms to shut down in the short run, others might continue to produce, right? So that's basically what's happening. And basically what that means is that firms that have lower costs, which means that these two curves, these two U-shaped curves are lower, they have lower costs. And so they can more easily survive lower prices, whereas firms that have higher costs, so U-shaped curves that are maybe up here, they're going to be the first ones to shut down and go out of business because they have higher costs. Okay, so that's basically what we're talking about here. All right, so here's a question for you, and I think I've already kind of alluded to this already, but why would firms choose to continue producing if they're not making a profit? And the answer to this, we have to recall the distinction between economic profits and accounting profits, right? So remember that when economic profits are zero, the firm still can have positive accounting profits. So that's partly the reason why. Think about this question. Why does the short-run supply curve, or what does the short-run supply curve look like for the individual firm? Well, as it turns out, for the individual firm, its supply curve is simply the marginal cost curve above its shutdown point, right? So, of course, if it's shutting down, it's not producing anything. Its quantity supplied is zero if it's shut down. But above that point, its supply curve is just the marginal cost curve, because the marginal cost curve is telling us, give me a price, and given that price, I can tell you the quantity supplied, right? That's the supply curve, right? The relationship between quantity supplied and price. And that's the marginal cost curve for the individual firm. Okay, so here is what it looks like graphically, right? So of course, here is the shutdown point at the minimum of average variable cost. So any price below that, the firm shuts down. So quantity supplied would be zero up to that minimum, okay? But then above that minimum, the supply curve is just the marginal cost curve, okay? So that's the supply curve for a perfectly competitive firm. And as it turns out for any firm, which we'll see the other types of firms in the following chapters. Okay, so that's the individual firm's supply curve. What about the industry supply curve? Well, we've already learned back in chapter 3 that the supply curve, the market supply curve, or the industry supply curve, is just the summation or the adding up of individual firm supply curves. So basically that's you're seeing what's behind the curtains from chapter 3 and market supply. Okay, so if we had two individual firms, here are their marginal cost curves, which are their supply curves. And if we add those up horizontally, we get to the market supply curve, right? So just to go through an example, right? If you suppose that the price is 6, firm 1 would produce 7, firm 2 would produce 10. So if those two firms constituted the market, together they would, as a market, produce 17 at a price of $6, right? And then you could do the same thing if the price was 10. That's the nature of horizontal summation. And as you should recall, hopefully from chapter 3, the factors that can influence industry supply are things like the firm's productivity, which are related to costs, factor costs, so the price of wages, the price of raw materials, right? In other words, the price of inputs. Also taxes and subsidies, as well as the number of sellers, right? Because if this is how we get to market supply or industry supply by adding up firms, the number of firms is going to determine this, right? Because if we have more firms, then supply is going to increase and get pushed out to the right. Okay, so that should be some review for you.